Physical Gold Fund presents The Gold Chronicles with Jim Rickard and Alex Stanton. Insight and analysis about economics, geopolitics, global finance, and gold.
Hello, this is Alex Stanzik, and welcome to another edition of The Gold Chronicles. This is The Gold Chronicles for April. I have with me today the brilliant Mr. Jim Rickards. Welcome, Jim.
Thank you, Alex. Great to be with you.
Just a couple of quick housekeeping items. A quick review of the last TGC that we did. We basically did a full spectrum review of current events, which includes currency wars, it includes trade wars, it includes potentials for kinetic warfare. And it was our very first ever video podcast, which has been pretty well received. Speaking of video, if you watch our podcast on YouTube and you think people need to hear this information, hear this message, please take just a second and do the little thumbs up thing. That's the like button. And then also subscribe to the channel. It helps a lot because what ends up happening is the algorithm picks it up and it syndicates it out. And so a lot more people will end up hearing this information. And if you're like me, I think that a lot of people need to get this information. So something else is that another thing that we're going to be doing is we're going to be actively monitoring your comments for questions from now on. So on the YouTube channel itself, if you leave comments on the podcast, we're going to do our best to answer those. If the question is particularly good or particularly relevant, what we'll do is Jim and I will talk about it in the next podcast. All right, so why don't we dive right into our topics. First up on deck is we're going to talk a little bit about gold. Jim, I thought what we could do is just go back to some basics. I know that every now and then it's good to just hit stuff that's kind of universal and timeless. We can always talk about current market events, but anybody can read a tape. I figured, if we talk a little bit about things that are sort of eternal principles or timeless principles, that might be good. So if it's okay with you, I'd like to talk a little bit about common objections. There's a lot of objections to gold in terms of as either an investment. You might be at a cocktail party or something like that, and you mention that you're invested in gold, and you get the typical responses, right? So I thought maybe what we could do today is talk about some of those. That's all right.
I think that's great. It's a very good idea, Alex. This is the Gold Chronicles. That's the name of the podcast. And we always talk about gold. Usually we run, 40 minutes to an hour. And we'll talk about a lot of things, as you mentioned, geopolitics, securities markets, a little bit of the political scene. I don't do a whole lot of politics, as you know, but to the extent it affects markets, we need to address it, whether we like it or not. And then we get to the end and we find some time to talk about gold. But I think it's great to, as you say, get back to the roots and just start with gold and do a little bit of a deep dive. And you're absolutely right about the cocktail party conversation. Your best friends will just look at you funny, and your less good friends will say something like, "What's wrong with you? Didn't you go to college? Whatever." Or some people just burst out loud laughing. So I'm pretty used to that. But the fact is, people base that reaction on a set of, if they know anything about it all, they might not know anything, which actually is the most common. They don't teach gold. They don't explain gold. Gold is not taught as a monetary asset, hasn't been for 45 years. I remind people, I got my graduate degree in international economics in 1974, and I was quite literally the last graduate level class that was taught gold as a monetary asset. Everyone thinks the gold standard ended in 1971 when Richard Nixon, August 15th, 1971, very famously or infamously suspended the convertibility of U.S. dollars into gold by foreign trading partners. Now, that had already been suspended by Franklin Roosevelt in 1933 for U.S. citizens. From 1933 onward, gold was contraband for U.S. citizens. It was like having drugs or machine gun or something. You weren't allowed to have it. But we continued to make gold convertible under the Bretton Woods system for foreign trading partners. And August 15th, 1971, Nixon ended that. Although, again, for people who've seen that, it's on YouTube. You can find his Sunday night speech. He preempted Bonanza, the most popular show in America, to give that speech, popular show at the time. He said, "I'm temporarily suspending the redemption." He used the word temporary, and they believed it was temporary. That's what Nixon and his advisors believe. I've spoken to two of the 5 people who were with the president at Camp David that weekend, and they both told me that, yeah, that's what we thought we were doing. We thought this was a temporary suspension. We were going to devalue the dollar, reset the price, carry on with the gold standard at a new level. But of course, that was 45 years ago, so the temporary became permanent. But that was not quite the end of the gold standard. It took a few more years because they, as I said, they did think they were going to reset the price. So we had the the Smithsonian Conference in December of 1971. Then there were some projects at the IMF, because this was a global issue, not just the United States. France argued vehemently in favor of the gold standard. They said, okay, you Americans screwed it up. You have to maybe devalue the dollar. But at the time, you still had the French franc. This was long before the euro. They thought they were going to go back to it. There were all kinds of fights inside the IMF. So no, it took a few more years before the gold standard was dead and buried. And that was 1974. So when I was in graduate school in 73, 74, we still had to learn it. And my professors at the time, let's say you have a 50 or 60-year-old professor, these were scholars who were the young guns of Bretton Woods. They joined the IMF when they were 25, 26-year-old students in the early to mid-1950s. They created and ran the gold standard for all those years. And then, so to say, some of them took the academic path, and they were my professors. So I was learning from the people who, in effect, created the Bretton Woods system, and we had pretty tough exams. So I just grew up internalizing it. I've always thought of gold as an asset, not to mention the fact that when I was a 9-year-old, my father would sit me down at the kitchen table and pull out an old silver certificate and a Federal Reserve note and put them side by side, as a 9-year-old, make me read what they said, convertible into silver versus Federal Reserve note, which is just an IOU. So I have it kind of in my DNA. But if you're younger than I am and you know anything about gold, you either went to mining college or you're self-taught, because they just stopped teaching it. So when you talk about gold, you typically encounter people who know nothing about it. In the monetary sense, they might have some jewelry. They might like it, think it's shiny and pretty, but they don't know about gold as a monetary asset. And if they know anything, it's probably a form of propaganda. One or more of the points that we're going to discuss today. Standard objections to gold as a monetary standard. Every one of them falls down. But why don't we, as you suggest, Alex, just take them one by one and explain what the conventional wisdom is and why it's incorrect.
Sure. All right. So one of the ones that's pretty common, and I'm sure you've heard this many times, is that if the idea is floated that gold can be used as a monetary standard, the thing that always comes out is there's just not enough gold to support finance and commerce. There's not enough.
Right. This is one of the many legacies, unfortunate, I would say toxic legacies of Milton Friedman. Milton Friedman was a great scholar, a great humanitarian, strong advocate for free markets, and I think we all respect that. But his economics were awful, and this is one of those examples. By the way, Milton Friedman was the most powerful voice in favor of going off the gold standard and going to what became floating exchange rates. The whole floating exchange rate regime that we have today, we take it for granted. Dollars up, sterling's up, euros down, yen's up, yuan's down, whatever. Well, all that craziness for all these, supposed to be money, supposed to be stores of value. Well, where's the value of cross exchange rates are going like this, continually, which they are. Well, we can thank Milton Friedman for that. Milton Friedman, typical academic, he just believed a lot of things that weren't true. He believed that central banks would manage their money supplies prudently, and so you wouldn't have those kinds of extreme fluctuations in exchange rates. Sorry, guess again. He believed that they would run their money supply in accordance with his vision of the quantity theory of money, which assumed velocity was constant, which it's not. Another incorrect assumption. It's a little bit like saying the world is flat. So there are all kinds of flaws in it, but that's where we ended up with these floating exchange rates. So, but Milton Friedman was a strong advocate for what he called elastic money. He said, look, the economy grows, or at least we hope it grows, and usually it does, except for occasional recessions. And so the money supply has to grow. Now, it can't grow too fast or you risk inflation, but he needed what he called elastic money. By the way, it's one of the big flaws in Bitcoin. All these cryptocurrency engineers think that too much money is bad, and they may be right about that. So their solution was to cap the money supply. That's not the right solution either. We'll come back to that. But Friedman wanted this elastic money supply. So what's happened is that since 1971, or pick your starting date, the economy has grown enormously. The money supply has grown enormously. The amount of gold currently in the system, and by the way, we need to distinguish between official gold and the total gold supply, and I'll come back to that. Official gold is about 33,000 tons. The price, it fluctuates, but today it's about $1,340 an ounce. It's been in that $1,330, $1,350 range for a while. So that's about where it is right now. And if you multiply that price by the 33,000 tons, you get a certain theoretical money supply. Well, here's how much all the gold in the world, all the official gold in the world is worth. And then you compare that to the economy, the size of the economy. Global economy is about $70 trillion. And you're like, hold on, that's not enough gold to support that amount of commerce. We'd have to shrink the money supply. Certainly, if you were backing currencies dollar for dollar at today's price, you would have to shrink the money supply drastically in order to maintain that gold standard, and that would be highly deflationary. It would throw the world into another Great Depression. So that part of it is true. But there's a very simple solution, which is raise the price. By the way, that's what FDR did in 1933. He increased the price of gold, the dollar price of gold, 75%. Now, he took it from about $20 an ounce to $35 an ounce. That's a 75% increase. Now, I would say it's not really an increase in the price of gold. What happened was the dollar devalued by 80%, but that depends which end of the looking glass, which end of the telescope you're looking through. But so if you want to go back to a gold standard today with the existing money supply and the existing gold, all you have to do is reprice the gold. Now, I've done this math. It's not complicated. We have the data. It's 8th grade math. Don't need any calculus or anything more demanding than that. And on a couple of assumptions, if you assume 40% backing, not 100% backing as some would insist, but 40% backing, which historically has worked. And if you use M1, which is one definition of money, it's funny. You have to distinguish between M0, M1, M2. I thought it was money. How come we have 3 different definitions? But right away, that shows you the beginning of the problem in terms of relying on central banks. But if you use M1 with 40% backing and the amount of physical gold, you come to a price of about $10,000 an ounce. So you don't need any more gold. Keep the gold you've got. Increase the price to $10,000 an ounce. Declare that the official price of gold, or the value of the dollar when denominated in gold, and go forward on a prudent, sound basis. So whenever anyone says there's not enough gold, just look at them and say there's always enough gold. It's just a question of price. You do have to get the price right. You can get that wrong, as Winston Churchill did in 1925, which was one of the precursors to the Great Depression. So, but subject to that, at $10,000 an ounce with 33,000 tons, that would back a $24 trillion M1 at about 40%. It would work fine, and then you could go forward from there on a very stable basis. So when people say there's not enough gold, just say there's always enough gold. You got to get the price right.
Right. And so a quick point on that is you had mentioned a $24 trillion M1. You're talking about global currencies, right? Not just US dollar.
Correct. And just the ones that matter. So that number, by the way, it's a moving target. I did that calculation recently, but you got to keep raising it because they keep printing more money. But that's US, Europe, Japan, and China. So those 4, counting the Eurozone as a block, all the members of the European Monetary Zone, plus China, Japan, and the U.S., 4 largest economies in the world, over 70% of global GDP. So that's what I'm using. So I left out Zimbabwe, but and some smaller countries. But that really is pretty much the whole puzzle, as they say.
Mm-hmm. You know what that reminds me of is that There was a meeting that I attended in China a couple of years back, and it was a Chinese think tank. They had a bunch of people for monetary policy from the Chinese government there, as well as representatives from all the usual suspects, the biggest banks in the world, who were there to give advice. And it came up at one point, because we were discussing gold, it came up at one point, and this is something that a lot of professional money managers will often throw out there, is that the gold market is simply not deep enough to absorb the kind of liquidity necessary to, for example, compete with the US Treasury market, things like that. And I made the point to them at the same time, which is basically the same thing that you said, is that if that's true now, but if gold were $10,000 an ounce, it's a completely different animal. You can tell all the banking guys got really uncomfortable with that, and the monetary policy guys were like, that's an interesting.
Well, my book, the New Case for Gold, I actually found a quote from an interview that Paul Volcker gave. And of course, Paul Volcker was the Undersecretary of the Treasury in August 1971 when Nixon went off the gold standard. He was one of the people at Camp David with the president. I spoke to Paul Volcker personally about this, but this was in another interview he gave, and the question was, could you go back to a gold standard? And he said very candidly and accurately and honestly, he said, you could, but he said, but the price, he was like, oh my goodness, the price would be sky high. In other words, he didn't do the math in his head, but he said you could do it, but the dollar price would be much, much higher. And so that shows a very good grasp of the issue, which is not quantity, it's price. And of course, Volcker understood that better than anyone.
All right. So
Sorry, Alex, if I can just interject one thing.
Sure.
I don't know of a market that's more liquid than gold. I'm a buy and hold guy, so I buy gold and hang on to it. But every now and then I've sold a little bit. Maybe you got to pay your taxes or write a big check or whatever, and I'll buy some more later. But I've never had difficulty when I want to buy gold or sell gold at the market. Have never had difficulty. Never had a phone call not returned. I've tried to sell municipal bonds where my broker said, "Are you kidding me, Jim? I can't dump these things." But I've never had difficulty with gold. That's at today's price. Certainly, if you had a gold standard at a much higher price, the liquidity would be even better. And don't be so sure about liquidity in the Treasury market. Look at October 15th, 2014. You had a price, you had a yield crash. We've had a couple of flash crashes in the Treasury market. Participation by primary dealers at auctions is declining. Participation by institutions at auctions is declining. Issuance is skyrocketing. I think I could get better liquidity in gold than you can in treasuries.
That's a very good point. Okay, so the next common objection is the gold supply doesn't grow fast enough to support GDP growth.
Right. So this is another one of these canards or red herrings or whatever you want to call it, but this one's pretty simple. So global economic growth, about 3%, give or take. It's been lagging a little bit. Actually, as we're speaking, the IMF is holding their spring meeting in Washington, and they do the World Economic Outlook. It's a big deal announcement this week. So they're going to update their forecast on global growth. It fluctuates, obviously, but call it 3%. Mining output, when I say mining output, so take the total stock of gold in the world, which is an estimate, but about 180,000 tons, maybe a little bit more. And then say how much are the miners producing, and what does that add to the global stock on an annual basis? Well, that number is a little under 2%. So you say, all right, well, global growth is 3%, mining output's 2%. It's close. It's not exactly right. It's pretty good, by the way. That's why gold is a very good monetary standard, because it grows about the level of global growth. And if you say that global growth is slowing, which it is because of demographics and other structural headwinds, and mining output even remains constant, I don't know if we're peak gold or not, but those two mesh up pretty well. It's not perfect, but nothing is perfect. It's a lot better than relying on central bank printing presses and uncertain velocity and M2 and money creation by banks. There are so many wild cards in that type of monetary system that I feel a lot more comfortable with gold. But having said that, it's completely irrelevant, because go back to what I said about official gold versus total gold. There's 33,000 tons of official gold approximately. There's 180,000 tons of total gold. That means you've got 147,000 tons of privately owned gold. So if you're a central bank and you have a gold standard, by the way, you can have discretionary monetary policy and a gold standard at the same time. It's not as if under a gold standard we're all going to walk around with gold coins in our pockets and pay our rent, walk down to the landlord and hand the landlord a gold coin or two to pay your rent. No, you can have printed money. It's just that it's backed by gold, convertible into gold at a fixed rate. That's what a gold standard is. So you can have a central bank and discretionary monetary policy and a gold standard side by side. And we did from 1913 to 1971. The U.S. had both. We had and still have a Federal Reserve, and we had a gold standard, and the U.S. stuck to that. So therefore, when you have this discretionary monetary policy, you go, gee, we're in a really bad recession, or we're in a depression. And good old Milton Friedman, told us, or Ben Bernanke told us we should expand the money supply. But gee, there's just not enough gold. Those miners aren't working fast enough. That's a drag on global growth. So what? Just buy some private gold. It's called an open market operation. It's exactly what central banks do today, but they do it in the bond market. You can do it in the gold market. So how does the Federal Reserve expand monetary supply today? They call up Goldman Sachs or Citibank. They say, offer me some 10-year notes or offer me some 2-year notes. Boom, done. The bank, Goldman Sachs in that case, delivers the notes to the Federal Reserve, and the Federal Reserve pays for it by crediting Goldman's bank account with money from thin air. That's how they create money. They buy bonds and pay for it with money that comes out of nowhere. By the way, right this minute, the Fed is doing the opposite. The Fed is actually destroying money. They're not selling any bonds. They're not doing that. But when the existing bonds mature, the Treasury pays them. Just as the Fed creates money out of thin air, if you send money to the Fed, the money disappears. So when bonds mature and the Treasury pays the money to the Fed does not buy a new bond, that money goes away. And the Fed is actually reducing base money. Picture Jay Powell with a pile of $100 bills and a roaring furnace and a shovel, and he's shoveling $100 bills into the furnace. That's what's going on with money supply right now. But having said that, when the Fed wants to expand or contract money, they buy and sell bonds. Well, you can just buy and sell gold. Call up, our friends in Switzerland, the refiners, and say, I'd like to buy 10 tons of gold because I need to expand the money supply. Print the money, pay, PAMP or Argor or, Johnson Matthey or any of the big refiners. Just pay them with money from thin air the way you pay Goldman Sachs or Citibank for the bonds. You've now expanded the money supply and you got the gold. In other words, mining output is irrelevant. The fact that mining output is about the same or even less than economic growth is irrelevant to the ability to expand the money supply on a gold standard. All you have to do is buy private gold, and there's lots of it. So there's really not a constraint. So that's another one of these things that on examination just completely falls down.
Yep. Okay. Next commonly heard objection. And this one, in our last podcast, Jim, we talked a little bit about the difference in mentality between people who have wealth and they're trying to protect it, and then people who don't necessarily have the wealth that they want yet. So they're basically chasing growth. They're chasing yield. You hear that all the time, chasing yield.
Right.
This objection comes a lot of times from people who are in that kind of frame, chasing yield. Sometimes they're professional money managers, sometimes they're not. But the objection is that gold has no yield. I think that came originally from Warren Buffett.
It's certainly one of Warren Buffett's complaints. By the way, one of the reasons Warren Buffett is worth whatever, $80-90 billion, he has this reputation as this awesome, incredible, stock picker. Well, he's pretty good, and he does fundamental analysis, and I don't want to disparage Warren Buffett's stock picking ability, but the reason he's worth $90 billion is because he's the king of tax-deferred interest, tax-deferred yield. This is why he buys insurance companies. In other words, when Warren Buffett was a little kid, he figured out compounding, and anyone who does the math understands the power of compounding. So he just said, if I can just not pay taxes, interesting, he was in favor of a tax increase for the rest of us, but back in the prior years, but he doesn't pay much in taxes himself. But be that as it may, that's the power of compounding. So Warren Buffett hates gold because it has no yield. Here's the answer. it's not supposed to have a yield. It's money. Some things have yields because they're investments, because you take risk, and other things don't have a yield because they're not investments, at least not in the conventional sense. They're money. And by the way, I'm going to do something I don't usually do. This is called, a little bit of stagecraft, but I just happen to have it handy. This is, I'm holding up a $100 bill. Hopefully our viewers can see this. So my question here, I'll turn it around so you can see Ben Franklin. So my question for viewers is, I'm holding a $100 bill in my hand. What's the yield? The yield is zero. This $100 bill has no yield. I took it out of my wallet. I'm going to put it back in my wallet. It has no yield. I don't have a piece of gold handy, but if I did, it would have no yield either. In other words, money has no yield. It's not supposed to have a yield. If you want yield, you have to take risks. If people go, oh, well, wait a second, my money in the bank has a yield. It's not much, a quarter of 1% or half of 1% or whatever. And I remind people, if you have money in the bank, it's not money. You may think of it as money, but it's actually technically an unsecured liability of an occasionally insolvent financial institution. How good was your money in 2008 when Lehman was failing and there was a run on Citibank and Citibank was failing? Talk to bankers, talk to anybody really. People were pulling their money out of the banks, stuffing it under a mattress, moving it around. If you had more than $250,000, they were spreading it around so they could get under the FDIC insurance cap. And one of the things the Fed did to restore confidence was to guarantee every bank deposit in America. Well, if that were really money, if that were like this $100 bill, or if it were like a bar of gold, you wouldn't have to guarantee anything. No one has to guarantee gold. If you have gold, it's gold. It doesn't need a guarantee. So the fact that they guaranteed it to stop the run on the bank tells you that it's not money, it's something else, and it is something else. It's a liability. And people go, I have money in the stock market. I have money in the bond market. I have money in real estate. No, you don't. You may have stocks, bonds, and real estate, but that's not money. If you want money, you have to sell them. And guess what? When you go to sell them, everyone else is going to be selling them because it's a panic and the price is collapsing and your money, the potential money you're going to get is disappearing in front of your eyes. So the answer is gold has no yield. Absolutely true. But that's because it's money. It's real money. This $100 bill is real money. It has no yield either. Gold's not supposed to have a yield. If you want a yield, you take risk. And if you take risk, it's not money anymore.
Yep. Okay. Very good. Next up, gold causes depressions and panics, particularly the Great Depression. I hear that one all the time. The Great Depression.
Yeah, and that's been the subject of a lot of scholarship by Barry Eichengreen. Where's Barry? He's at University of California, Berkeley. Paul Krugman, Ben Bernanke, many others. I haven't spoken to Krugman. I've spoken to Bernanke and Barry Eichengreen, a number of other scholars on the subject. So here's what they say. They look at all these financial panics historically, and there were a lot of them: 1837, 1873, 1893, 1907 was a classic, 1929, etc. And they say, they all involved a run on the bank and people grabbing their gold and liquidity traps. And in 1929 in particular, the fact that you were on a gold standard meant that you could not expand the money supply fast enough to get out of the depression. And gold, therefore, caused the Great Depression. Now, that's wrong, but let me explain why it's wrong. Barry Eichengreen is a great scholar. He did the following. He looked at all the countries, all the major trading partners in the world during the period 1929 to 1933. And he said, when they got off the gold standard, they started to grow because they didn't all break with the gold standard at the same time. France and Belgium devalued in 1925. The UK devalued in 1931. The United States devalued in 1933. France and the UK devalued again in 1936. It was the tripartite agreement. And there were other examples of Italy, Belgium. And remember, there was no euro at the time. Of course, these were all separate countries, had their own currencies and their own gold standards. So he showed that if you went off the gold standard, you grew, and the people who stayed on the gold standard did not grow as fast. And voila, getting off the gold standard gets you out of a depression. Well, and he did it. It was great scholarship. It was very hard to kind of come up with all that data and do that work, and maybe he'll get a Nobel Prize for it. But what that ignores is that the countries that grew did so at the expense of their trading partners. In other words, it was just it was a monetary version of beggar thy neighbor trade policies. So empirically, did they grow? Yes. But you can't conclude that abandoning the gold standard was the key to growth, because if they had all abandoned the gold standard at once, they all would have grown the same. If they had all remained on the gold standard at the same time, they all would have grown the same. It was only because some did and some didn't that the ones who abandoned stole growth from their trading partners. Global growth, the world did not grow. See, this is the point Icahn Green misses. The world did not grow. The world continued to contract. Now, did certain individual countries grow? Yes, but they did so at the expense of the rest of the world. So that's not a solution in a global depression or global panic. The other point is, and Krugman is particularly glib about this. He says, the Fed should have done QE in 1929. They could have got us out of the Great Depression faster if only they had printed a lot more money. There is no evidence for that. They say gold constrained the ability of the Fed to print its way out of the Great Depression. But actually, the guy who refutes that, and I've read the research, is Ben Bernanke, because Ben Bernanke showed, and I spoke to Bernanke about this person. I said, Mr. Chairman, I said, I read your book and I read your research, and here's what I think you said, but do I have that right? And he said, yes, you do. And what he said was that gold was not a constraint on the increase in the money supply in the Great Depression. At the time, we had a certain amount of gold, and we were on a gold standard, and there was a fixed ratio between money and gold. That was all true. But the law said that the Fed could print up to 250% of the market value of the gold. So take the amount of gold we had. At the time, it was $20.67 an ounce. So just do that math. That gives you a number times 250%. That was the legal limit on base money, M0. The Fed never got to 100%. Now, if hypothetically, and Bernanke showed this, if hypothetically the Fed had got to 250%, maybe then there would have been a constraint, but it never happened. They never got past 100%. The problem was not that the Fed couldn't print more money. They could. The problem was that nobody wanted it. Nobody wanted to borrow. Nobody wanted to lend or spend. We were in a deflationary period. When you're in a deflationary period, the last thing you want to do is borrow money, because when you pay it back, the money's going to be worth more. What you want to do, and people were taking it out of the bank, they're like, hey, I'm not losing any interest because the value of the money is going up every day. That's what deflation is. Now, this is a liquidity trap, as Keynes defined it. This is a problem. I'm not saying this wasn't a problem, but I'm saying the problem wasn't gold. The problem was confidence. The problem was policy flip-flops from Hoover and Roosevelt. And there's this whole notion that Hoover was a bonehead and Roosevelt was a genius. You look at the policies, they were very much the same. Well, I'm not name calling. Hoover's policies and FDR's policies were very much the same. They were highly interventionist. They would do something. If it didn't work, they would try something else. They ignored the fact, and historians, by and large, except for a few, Amity Shlaes is one who gets it, but they ignored the fact that all that flip-flopping destroyed confidence. Capital went on strike. Capital went to the sidelines and said, hey, call me when it's over, when you're done with all these administrations and all that. We'll get back to it. So there were causes for the Great Depression, but they had to do with asset bubbles caused by earlier Fed blunders. They had to do with Fed tightening at the wrong time. They had to do with discretionary monetary policy. They had to do with policy coming out of the executive branch that caused the loss of confidence. It did not have anything to do with gold. Gold never acted as a constraint on money supply. The constraint was people didn't want the money. They didn't want to borrow and they didn't want to lend. Now, having said all that, tell me that we haven't had financial panic since the end of the gold standard. So let's just take since 1971. Okay, no more gold. So according to Krugman, we're not going to have any more financial panics. Well, what was 1987 when the stock market fell 22% in one day, equivalent to over 4,000 Dow points or 400 S&P points today? What was 1994, the tequila crisis with the Mexican peso? What was 1997 in Thailand? What was 1998 with Russian long-term capital? What was 2000 with the dot-coms? What was 2007 with mortgages? What was 2008 with Lehman? In other words, we've had one long string of financial panics, liquidity crisis, et cetera, after another without the gold standard. So if you're a statistician, you would say, well, we had panics with the gold standard. We had panics without the gold standard, so there's no correlation. therefore no causation, and gold has nothing to do with it. And that's the right conclusion. So they're just using gold as a whipping boy. They're using gold as a kind of a boogeyman with regard to financial panics. Financial panics are behavioral. They're not monetary. They're psychological. They're very hard. They're kind of easy to foresee, hard to predict the exact timing. You don't know exactly what's going to trigger it, but they are behavioral and psychological, not primarily monetary, and they have nothing to do with gold.
Yep. Okay. Very good. So moving on, the next common objection when it comes to gold is that gold has no intrinsic value.
Well, this you hear all the time, and it's probably the one you hear most frequently is, well, it's just gold. Joe Weisenthal on Bloomberg, nice guy, he makes fun of me. He says, Jim, you support gold. It's a shiny rock. I say, Joe, it's not a rock, it's a metal. So why don't you get your chemistry and your geology straight? It is a metal. But they go, well, you look at it, it's pretty, you can put it on the shelf, but it has no intrinsic value. Oh, well, what does that mean, if you even know what you're talking about? And I think most people who use that phrase do not know what they're talking about. The theory of intrinsic value goes back to David Ricardo, one of the great economists of all time, early 19th century economist. And he was trying to solve a problem. He was trying to say, well, what are things worth? How do we value things? How do we, when we decide that something's worth a certain amount or something else is worth more or less, how do we do that? And so his theory was, okay, well, let's take the inputs. How much labor, how much capital, how much in the way of raw materials, what went into this, add it all up, and that's the intrinsic value, and that's what the thing is worth. Okay, so flash forward about 30 years, and here along comes Karl Marx. And Karl Marx looks at Ricardo's intrinsic theory of value and says, yeah, that's a good theory. And oh, by the way, you've got multiple factor inputs. You've got labor and capital. But because capitalists control the means of production, they don't give labor their fair share. So there's some intrinsic value, but labor doesn't get all it deserves. There's surplus labor value, and that goes to the capitalists because they control the means of production. That's unfair. That's going to lead to a revolution, communism, and all the rest. We're all familiar with Marxian dogma. But he was using the intrinsic theory of value. He was just adding to it by saying, yeah, and somebody is taking more than their share. Okay, so that was called the surplus theory of labor value. Come forward another 30 years, 1871, Vienna, Austria, University of Vienna, Karl Menger, the founder of Austrian economics. He said, nonsense. He said, nice job, Ricardo. You were solving a hard problem. Marx, you got a little crazy with the whole thing. He said, there is no intrinsic theory of value, or at least that's not the way to think about value. Value is subjective. And the way we think about this, the common expression is something's worth what somebody will pay for it. I got a pen right here. If I want to set, what am I offered? I could put it on eBay. I might get 2 cents. You might get 5 cents or $1. I don't even know. But the point is, it's worth what somebody will pay for it. And this is why we have markets, so we can have price discovery. And this is why we have eBay, for that matter, in the 21st century version. In other words, it's fine to say something's worth what somebody will pay for it, but how do people know it's for sale? How do people know that if they're looking for it, that they can even find it? Well, that's why we have markets. And then that led to a free market theory. That was the basis of Austrian economics, and that was brought forward into the 21st century. Later on, we get into Keynes and Milton Friedman and some variations on that. But ever since 1871, all economists, neo-Keynesian, monetarists, modern monetary theory, Austrian, historical, pick your school of economics, they all think that Menger got that right. That, basically things are worth what somebody will pay for it, and we need markets to discover that. And despite market imperfections, that's a separate discussion. So when someone says to you, gold has no intrinsic value, you should compliment them on their firm grasp of Marxian economics and remind them that has been junk science since 1871. So in other words, the theory of intrinsic value has nothing to do with what things are actually worth.
Mm-hmm. And this reminds me of another conversation we had recently, and I think it was a couple of podcasts ago, but we were talking about gold's unique properties. And one of the things we were talking about is how gold is unique in physics. There are lots of different forms of money all throughout history. There have been shells, there have been feathers. wooden sticks, cows, on and on and on. Common thread amongst all of them is confidence, of course, right?
Right.
But something that was unique to gold, and this is a physics property, is that you really can't destroy gold. The gold, really, you'd have to take it apart at a subatomic level in order to destroy it. You'd have to fire it into the sun or something of that nature. And
right.
And my feeling on that is that's kind of ties into why it's been money for so long, is because humans are our own value, or value for our labor. We want something that's going to retain that over time. And I think that that's been very attractive, or part of it.
Well, I think that's exactly right, Alex. And combine that with what we said earlier about mining output. It's not like miners aren't trying. It's not like they're not out there, doing the geology, doing the surveys, doing the feasibility studies, gathering capital, drilling, testing, core samples. I've been to mines. I'm sure you have as well. I've been to the other end of the spectrum, which are refineries and vaults where the finished product comes out. But I've also walked around, the Quebec and future mines, just walking around rocks in the middle of nowhere. And I've seen that end of the business as well. The fact is try as hard as they might, they can only increase the physical supply, as we said, just a little under 2% a year. It's interesting to me that syncs up kind of with population growth and productivity. This global output. We don't have to get theological, but is that sort of a God-given property of gold, plus the fact that it's an element. It's not a molecule. It's an element, atomic number 79. It does have these properties that make it extremely suitable as money. You can say some of the same things about silver, not all of them, but silver is a close second. But there's nothing like gold. There's never been a form of money that has worked as well as gold. I obviously invest in physical gold, and recently, and this is very recent in my case, I've started collecting rare gold coins. When I say rare, we're talking about 1,400 years old, the Aureus and the Solidus from the late antiquity, just for fun. And I have no illusions that I'm getting my money's worth in gold. Whatever I pay, I'm paying for the numismatic value. I don't think that it's not a good way to invest in gold. Let me put it that way. It's a hobby. If you want to invest in gold, get an American gold eagle, an American buffalo, a maple leaf, a 1 kilo bar from a reputable refiner. That's the way to invest in gold. Don't pay up for, a 33 Morgan, whatever, unless you're a real collector and you know what you're doing. But it's not a good way to buy gold, as I say. But if you're a collector, so anyway, I've started buying these coins. They're beautiful. They're very interesting. And then you study history, which I do quite a bit, and you see that these were the greatest empires in history, and they lasted a long time while they had that as a monetary standard. The minute they abandoned it, one way or the other, either by clipping the coin, or you actually see these coins with little clips all around them, everyone took a little piece and melted it down, or in the case of silver, or gold for that matter, mixing it with base metals, or abandoning it completely, etc., those empires collapsed. And so, hopefully the U.S. will wake up before it's too late. But it is an extremely suitable form of money. When you say something like that, people go, "Well, come on, Jim. There's progress. Horse-drawn carriage used to be a good way to get around, but we don't do that anymore. We use cars, and pretty soon we'll have electric cars." I understand that. I recognize progress. I recognize technology. I actually embrace it to a great extent. But not everything that has ancient roots is to be abandoned or has been improved upon. Some things have not been improved upon, and I would say gold is one of them.
Sure. I totally agree. You know that I do. Both of us students of history, and that's where the term debasing the money supply came from, or debasing the money came from, is what you just mentioned.
Right. And I guess you could say, gold is an ancient form of money, but it's not as if paper is not also an ancient form of money. It goes back to the 7th century Tang Dynasty in China. It's been tried many times and always fails. So it's not as if you have, maybe you could have a different debate with Bitcoin. We don't have time in this podcast for that, but because Bitcoin is new. By the way, I don't recommend Bitcoin. I have a whole long criticism of Bitcoin. But if gold were ancient money and paper money were some new late 20th century invention, maybe you would say the jury's out on paper. But paper's not new either. It's been around not as long as gold, but quite a bit of time. So you actually have two very old forms of money that have competed head to head time and again over thousands of years, and gold always wins. So that's again, if you're a student of history and monetary policy, you understand that.
Yep. Okay, last one, and we're running up close to the end of our podcast here. We had lots of other topics on deck, but this has been a fascinating discussion. So, in the same vein, the last one is John Maynard Keynes saying that gold is a barbarous relic.
Well, there's a short answer, but I'll give you a slightly longer backstory. The short answer is he never said it. And this is the one, other than intrinsic value, this is the one you hear the most. When you say, like, I buy gold or I have gold in my portfolio, usually the first one is has no intrinsic value. We already disposed of that. But the other one is it's a barbarous relic. Well, Keynes never actually said it. And, you see it quoted all the time. Gold is a barbarous relic. You find it on Wikipedia, and I write books and I do a lot of research, and I'm fanatical about sourcing. And I was finding different versions of this quote in different citations, and I said, this is important. I want to get this right. And I actually went to an antiquarian bookseller, and I got a first edition of John Maynard Keynes' Monetary Theory from 1924. Interesting, it was 1924. That was before England went back to the gold standard, and before, certainly the 30s when they abandoned it, et cetera. And what Keynes actually said, he said the gold exchange standard is already a barbarous relic. In other words, he was not talking about gold. He was talking about the monetary arrangement of the day, which was the gold exchange standard. This came out of the General Conference in 1922. And the word gold exchange means gold plus foreign exchange. So the question is, if you're a country and you have trading partners, what are good reserves and what can you use to settle your balance of payments? So you have a trading partner, you're on a deficit, you've got to pay the other guy, whether it's England and France or Italy and Belgium, whatever it is, or the US for that matter, you've got to pay the other guy for your deficit in something that they accept. And so the question is, what's acceptable? And they all agreed that gold was acceptable, but they also said that certain kinds of foreign exchange, pound sterling, French francs, US dollars, were also acceptable. And this is a way to expand the money supply. So it was gold plus foreign exchange. So they called it the gold exchange standard. That's what Keynes was talking about when he said it was a barbarous relic, because he said it wasn't working well. And he was right. I agree with Keynes on that. But he did not say gold is a barbarous relic. He said the gold exchange standard of today is a barbarous relic. So it was, and by the way, in 1914, at the outbreak of World War I, the UK, the Exchequer and His Majesty's Treasury were considering going off the gold standard because Germany, Belgium, France, all the other combatant, belligerent nations had already done so. Bear in mind, the U.S. was not in the war at that time. We joined in 1917, but the U.S. was a neutral power from 1914 to 1917. But so all the other countries, all the belligerent powers had gone off the gold standard. UK was still on it. And there was a debate about whether they should go off also. And Keynes was the loudest, most persuasive voice saying, no, stay on the gold standard. And he had a reason. He said, London is the heart of global finance. We have the best credit in the world. If we abandon the gold standard, we'll destroy our credit. If we remain on the gold standard, our credit will be preserved and we'll be able to borrow. And borrowing is the key to winning the war because nobody has enough money. Look at all the, he says, nobody has enough money to fight the war unless you can borrow. And of course, printing money is just a way of borrowing from your own citizens. So he said, we'll stay on the gold standard, preserve our credit bar. And that's exactly what happened. The House of Morgan, Jack Morgan, who was the son of J.P. Morgan, who was running the House of Morgan in 1914, organized huge loans for France and the UK. You know how much he raised for Germany? Zero. Morgan did not raise a penny for Germany, and the UK won the war. So Keynes was right about that. Flash forward 30 years later, in 1944, Bretton Woods, who's in favor of a gold standard? John Maynard Keynes. The U.S. wanted a gold standard, but we wanted a different kind of gold standard. In the U.S. vision, the dollar is linked to gold, and everything else was linked to the dollar. So there was a dollar sterling exchange rate, a dollar franc exchange rate, et cetera. And then the dollar was linked to gold. Now, indirectly, everybody else was linked to gold. But all those other countries could devalue. You could, if your terms of trade had changed, if you had persistent deficits, if you made the structural changes, if you couldn't get out of it, you could apply to the IMF, and subject to a process, you could devalue your currency. The one country that was not allowed to devalue was the United States. So this was a dollar gold link, and everyone else is hitching a ride to the dollar. That's not what Keynes wanted. Keynes wanted a world where you had world money, which he called the Bancor, something like the current special drawing right, that was gold backed, and then everyone else could, link to the Bancor, and there would be more multilateral control. Well, Keynes got shot down, but my point being, Keynes advocated for gold in 1914. He advocated for gold in 1944. He never said gold was a barbarous relic. So this is just another, as I said, if Keynes were alive today, he'd be spinning in his grave.
Sure. I suspect it's one of those things where it's just an easy thing for people to remember. It's like that's what makes the best memes are the ones that are easier for people to remember and to repeat.
But that's true of this whole podcast. Is gold's a barbarous relic. Gold has no intrinsic value. Gold caused the Great Depression. There's not enough gold. I mean, everything we've gone through, Alex, is just sort of off the top of the head. All-purpose rebuttal to gold, and none of them are true. The only one that's true is the one that's irrelevant, which is gold has no yield. It's like, yeah, that's not supposed to.
Yeah, that's great. So this has been a super interesting conversation. We spent almost an entire hour doing a deep dive on this. We had a lot of other stuff lined up, but I think this has been a great. We're pretty much out of time, Jim. So I just want to say thanks for the discussion today. Appreciate it as always, and look forward to getting together with you next time.
Thank you, Alex.
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanzi, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.